Hi, this is Mike Regan, and I'm delighted to bring you a special edition of our On the Record series. And I'm delighted because we have our friend Peter Tirschwell, who's the vice president with IHS Markit, and basically runs the ocean area for the Journal of Commerce, is an expert. We've had Peter on webcast interviews. Folks, if you're not a Journal of Commerce subscriber, you need to do that like yesterday before I even have Peter speak. I just want to make sure because there is incredibly valuable information. I've asked Peter to join us today to talk about the situation in the Suez Canal. While the Ever Given has been freed, it'll have some significant impacts. So Peter, welcome to this On the Record edition featured on or focused on ocean.
Hi, Mike. Happy to be with you.
Okay, so Peter, a couple of weeks ago, we interviewed you on the critical situation in the ocean markets. March 23rd, we get a ship stuck in the Suez Canal. Help us understand the ramifications and how this will impact ocean freight, global supply chains, and things like that.
Yep. Well, again, Mike, happy to be with you. A couple of things I would say. First of all, we don't know what caused this accident yet. And we should be careful about jumping to conclusions about why it happened and what kind of operational changes might be required to ensure it doesn't happen again. So this type of accident is extremely rare in the Suez Canal. I certainly had never recalled anything quite like it. And so, was this a freak windstorm? Was it human error? What exactly happened is unclear. So we can't jump to any conclusions about why it happened. But what we do know, obviously, is that it did happen, and the Suez Canal was blocked for nearly a week. And as a result of that, what had already been a very stressed container system globally is going to become even more stressed. Probably during a period of a month to maybe 6 weeks until this all evens out. Now you got to remember though that we weren't starting from a normal situation when this happened. When we talked the last time, we were talking about how the sort of global circulatory movement of containers really had slowed significantly because ships are taking longer to unload. Longshore workers are not working at full productivity. There aren't enough trucks. Warehouses are taking longer to turn containers around. And as a result, the overall capacity of the container fleet itself was already significantly reduced. This is the reason why we're hearing so much about shippers having a very hard time obtaining containers, why ocean carriers are rushing containers back to Asia as quickly as they can, and incurring the wrath of politically active shippers like U.S. exporters, for example. So it happened already at a very difficult time, and it's only going to make the situation worse. But it's only going to make it worse temporarily, and then it's going to go back to what was already a stress situation, which could, continue to remain for many months to come.
Okay, so Peter, ahead of our call, you and I had talked, and could you make sure our audience understands one of the things that we have said is that there is a fixed number of containers in the world. Okay, it's not like I can just go and miraculously produce containers. There is a fixed amount of containers. And so one of the things that I was talking with another shipper about when he was saying, why is this happening, is that when we slow down what I call the velocity of how those containers turn, it has an impact. And so when we don't have any what I call surge capacity, and I slow down how those containers are turned, it's going to have the impact of driving up cost in a really significant way. Like we have shippers telling us they're paying 2 to 3 times as much to move containers versus this time last year. Is that a reasonable assessment of what's going on in the market today?
Yeah, essentially, because when the velocity of container circulation slowed, essentially it took capacity out of the system. So for example, if we were to go back roughly 12 or 13 years, when the ocean carrier, this is just prior to the financial crisis, the ocean carriers were experiencing overcapacity in their industry, and they decided to take coordinated action to reduce the speed of their ships. So that the term we now know as slow steaming originated probably around 2007 or thereabouts, where the container lines slowed their ships by 4 or 5 knots, and in doing so effectively took capacity out of the system. And that's exactly what's happening with containers right now. And so when capacity comes out of the system without new construction of containers really compensating for the overall reduction in capacity that's occurred due to this slowing velocity, because there has been some increase in production, but not nearly enough to offset the loss in capacity due to the decline in velocity. Simple economics are going to kick in and prices are going to go up.
Okay, so let's talk. It's not just containers, but one of the things that you and I have talked about is what I'll call the velocity of how the ships are turning. So a lot of ships, I think as we were recording this, which is the end of March here, now with the Suez opening up, there were about 360 to 370 ships waiting to transit the canal. And one of the things that it pointed out was that a lot of ships had made the decision to go around Africa, Cape Horn. And they're going to increase, I think they said that's an additional $250,000 to $260,000 in fuel cost. But more importantly, it adds anywhere, 8 to 10, possibly 14 days to transit time. So what I've also done is taking capacity out of the ocean carrier side of the equation as well, correct?
Correct, and that's so it definitely happened because of that, and also you have to remember that even again before the Ever Given became we might have to edit this out, but before the accident occurred that blocked the Suez Canal, there was already tightness in the container supply as well. So the tightness in the market was seen in the containers, in the container ships also, because, and you see this in the fact that almost all of the container ships are fully deployed, very, very low level of idle capacity, according to Alphaliner, which tracks those numbers very closely. And the charter rates on container ships are way up. Meaning that any available ship on the market is being snapped up, and they're being snapped up and chartered at extremely high prices, which means that you can see that there's overall stress on the ships, on the containers, and even if you go on the land side, you see this in the trucks, as you mentioned, you see it in the chassis. You see it all throughout the system from one end to the other, and that's what's causing so much of a headache for CEOs who for years and years never had to deal with any significant supply chain problems, and now they're being hit left, right, and center by one significant issue after another.
Well, and it was reported on Monday, March 29th, there were 53 or 55 ships waiting to get into the ports of Long Beach in LA. And that's going to translate, just so people have some kind of benchmark, if those are 10 to 13,000 container vessels, that's going to translate into the need for about 275 to 300,000 truck moves. And that's just to handle the ships waiting. So can you help us understand, I mean, hopefully for the audience's benefit, we've helped them succinctly clarify that the markets are going to be extraordinarily tight. The Wall Street Journal ran an article on March 18th saying the global supply chains are a mess. Industry ran an article, Volvo is shutting down production lines for their trucks, Mercedes. A friend of mine that's in the automotive part said, fancy this, we're not being able to produce $50,000 cars because we can't get $30 chips. But so help people understand this, looking forward into 2021, We recover from this with the Suez disaster. You say 4 to 6 weeks before we have a chance to rebalance the impact of this shock. But that puts us then almost into June. Okay. Forecast for the remainder of 2021, what would that look like?
Well, so even before the Suez accident occurred, we were already looking at an enormous ongoing crisis underway. I mean, you mentioned LA Long Beach. I think the number right now is approximately 25 ships, 25 container ships that are at anchor awaiting berth, and that number is anywhere from 40 down to 25 over the last 3 months. So the number really hasn't come down much. There's still a whole armada of ships that are awaiting, and the macroeconomic factors that are driving this are not going to go away. I mean, obviously, a huge impact from the shift in consumer spending from travel and leisure to home goods, PPE, things like that. The Goldman Sachs is forecasting a 6.5% GDP growth in 2021 in the United States. 6.5%. Think about that. I mean, that's higher GDP growth than we've seen in years, and it's the first time that our GDP growth is going to rival China's since the early 1990s. I mean, to the extent that this is going to translate into consumer spending for hard, durable goods of the type that move into containers, then we are looking at essentially a merging of this period that we're in right now, where we're seeing sustained heavy volumes, pandemic driven. That's going to merge into the traditional holiday peak season, which on the ocean side typically starts July, August, September, and then it flows deeper into the supply chain, where the trucking peak season tends to be a little bit later on the year, and then the peak season ends with a bang with parcel deliveries right around Christmas time. But I will tell you that since our TPM conference, the bias in the interviews that we've done has almost exclusively been in the direction of an earlier start to the peak season, a longer a stretch here of very, very heavy volumes, continued disruption, basically going potentially throughout the entire year. And then who knows what 2022 is going to bring.
So a question for you as we wrap this up, just two questions. So question number one, people have been asking us, because we frequently are helping them from a budget perspective, what are freight costs going to look like? I've said you can pretty much take, assuming that you did the same number of containers as last year, it's pretty safe to say you can at least double and trend towards tripling your ocean freight cost for the same volume of containers. Is that a reasonable forecast?
I think it's a little high on the spot market. To the extent that you're exposed to the spot market, you could be paying very, very high rates. I mean, one of the things that we're seeing now is the annual contract rates on trans-Pacific imports from Asia, going from say 1,500 to 2,500 or 1,500 to 3,000. So we're talking increases of 60, 70, 80%, 100%, possibly more. So doubling for sure. Tripling on contract rates sounds a little high, but now you're talking about a doubling of your annual costs. So in other words, you're talking about locking in ocean costs at double the rate of your prior year. So that's the type of cost increase that companies probably have never experienced.
And the only reason I mentioned the tripling was because I got a call from a dear friend of mine who told me he had flown out of town to sign a contract with his ocean carrier, and he was really excited to sign this ocean contract because his rates were going to go from 1,300 to 3,100. And he said he wanted to get there and sign the contract before the carrier changed their mind. But we're also seeing, stupid, crazy. But by the way, I just want to emphasize for the audience, we can provide you with a link to the JOC's TPM conference. JOC was kind enough to provide us with a discount, and they can get all of the content that was covered at the the TPM, and there are some sensational interviews you did with CEOs of ocean carriers and this type of stuff. But one final question now. So I'm sitting here and I say, congratulations, Mike and Peter, you've scared the bejeebies out of me. Give me a couple of things that my company can do if I want to try and get ahead of this and proactively get my arms around it to do the best possible job I can in managing in these turbulent times. What 2 or 3 things would you recommend for them to do?
Well, the first thing that I would recommend, and this will come off as shamelessly self-serving, but become educated. Understanding the international logistics environment requires time. It requires relationships. It requires education and learning how the market works, learning the nuances, learning the tricks, learning the ins and outs. And the reason why I would put it that way is that for so long, when ocean rates were low, when overcapacity dominated the market for literally over the period of an entire decade since the financial crisis, this was an area of specialty that companies could be without. Now they have to come up to speed at a more senior level. And it can't just be left. The logistics teams are great teams, but they need support, and they need support of senior management. And it can't just be that the logistics teams are held responsible when things go wrong and unacknowledged and unsupported when things are going well. It's a mindset change where companies are really going to have to embrace an area of specialization that they in many cases were easily able to let run itself without a second thought. But that's now changed.
Maersk has said that they want to focus on long-term relationships, customers, and other carriers have been there. But could you help our audience understand from your perspective? I mean, you're the expert in this area. Aside from getting educated, is there stuff that they could do from their procurement or sourcing perspective?
Yes,
that would help stable capacity in the future?
Sure. So I would say that a pure procurement mindset, which has existed at many shipper companies, where the primary objective was driving down cost. Well, actually that was successful over any number of years because they were able to drive down costs. But now the ability to drive down cost is much more limited. And the way to work the system effectively is to build vendor relationships and build carrier relationships, build forwarder relationships, and understand going into those relationships that the best transportation relationships are a two-way street. They are a win-win scenario between the carrier and the shipper. And that is whether you're talking about trucking, whether you're talking about rail, whether you're talking about ocean. What can you do as a shipper to make your business be attractive to the ocean carrier in the case of an international ocean container scenario? And that means sitting down and building the type of relationships that's going to allow you to learn what it is that's going to take to create a successful working relationship with a carrier.
So to that end, one of the things, Peter, I want to encourage our viewers to do is go and listen to another interview that we shot with you about a month ago, where you talked about what that looks like. Because in that interview, I just want to highlight for our audience that you mentioned things like, carriers are going to get real sensitive on ghost bookings, ghost freight, where you book your container on 4, 5, 6 ships in the hopes that one of those 6 can get it. The carriers have the data now to identify that. And so, the second thing that you had also mentioned is a recognition that they may have to pay, for example, a premium to basically what I call VIP status, where their containers are assigned a different priority level. Is that something that's reasonable in terms of advice for ocean carriers or ocean shippers rather?
Well, I think that there's a couple ways to look at it. One is on a long-term basis, understanding that risk mitigation, resiliency, redundancy, agility, visibility, all of this focus on supply chain is going to become much more important than it was. Another area is building building the type of carrier relationships that are going to work for both sides.
Peter, listen, as we close this out, you've given us some great input. And as I mentioned to our audience there, we encourage you to go and listen to the interview we shot with Peter last month, where he talked about the impact of the carrier alliances. You can educate yourself we'll give you the link to look at the TPM conference. It was fantastic. Now, there's some tangible things that we can tell them to do, or, that they can look at and say, yes, we can start doing this tomorrow.
Yeah, certainly. I think one of the things that is going to come up very frequently as a result of the situation we're in right now, and it kind of goes back to what we started talking about in terms of containers. The carriers are desperate to get their containers back from the shippers, and they are clamping down on the free time that shippers have to unload containers, and they're being much less generous in terms of the time that those containers are going to be allowed to be out on the street. So to the extent that shippers were using the marine terminals to store containers, negotiating extended free time, not taking delivery because they don't have enough parking space at their distribution centers. A lot of the whole import system, for example, has been based on the fact that shippers were given very, very liberal free time on containers. And so now you're increasingly going to have less ability to store containers. You're going to have to take delivery. You're going to have to unload containers. You're going to have to get them back to the ocean carrier, or you're going to have to pay. So therefore, if you want to pay, a higher amount, that's fine. That's one way to do it. But increasingly, in talking to ocean carriers and in talking to shippers, it's going to require a rethinking of exactly how you receive imported merchandise. Are you going to need larger parking areas? Are you going to need longer distribution center hours so that you're receiving goods during times of the day when you didn't in the past? Or are you just going to accept that you're going to have to pay? This is going to be I think the next big challenge for a lot of shippers to really stare at this issue right in the face and get control of it.
That's perfect. And, Peter, could you just briefly touch on this? Because one of the things that you and I briefly talked about, I mentioned this, that one of my friends that was going through an ocean contracting session right now, he said the thing that stunned him was this year more so than ever before, the carriers came armed with data. And the data that they had, in line with what you were saying, is something that we've championed. Are you a steward of their assets? Are you a good steward? Are you turning those containers? Are you doing? And the other thing he mentioned was the other challenge is looking at this holistically, so that it's not just the ocean carrier, it's my entire drayage network, it's things like that. I need to basically look at this from a sequencing perspective to make sure that from start to finish I am doing everything to, you say the shipper of choice, but to basically be as efficient as I possibly can if I want the carriers to extend to me the kind of treatment I'm looking for. Is that a reasonable summation?
Absolutely. And the great thing about it is because many of the carriers, not all of them, but they're coming up to speed very quickly on their own data, as you say, that it's going to allow for a much more fact-based dialogue with carriers going forward. Because if you're really good at this, then the carrier is going to come to you and he's going to say, hey, you know what, Mike, you did pretty well. And, we have data to say, this is working, and, we like you and we appreciate the efforts that you're making in order to work more effectively with us. Those are new conversations.
Yes, they are. I've also said to one CEO, you're going to have to rethink your inventory deployment models, because, I can share with you, some companies we're talking to have now gotten religion, and they've identified critical parts in their supply chain. And they are going overboard to make sure that those parts they'll always have them in stock, so they don't experience the type of things Toyota, Honda, Volvo, and others have experienced. Peter, I cannot thank you enough. I look forward to continuing the dialogue and keeping our customers and friends and our audience informed about things they can do to effectively manage their supply chain. So thanks so much for your time.
Appreciate it, Mike. Always a pleasure to be with you.